Hi everyone, welcome to ACCA P6 UK lectures brought to you by AccountancyTube.com. Myself, Faisal Farooq, I'll be teaching you P6 UK lectures through this platform AccountancyTube.com. Now I've listed down the income tax pro forma on the board. That's what our first chapter is. As I said in the previous lesson that we will move to our subject areas, because the previous lecture was just about an introduction about myself and the subject, and we also talked about the AccountancyTube as well. Now this pro forma is already given to you in the lecture notes, which you can also download free of cost from our website. Please make sure you download the lecture notes while you're watching me do these lectures, because most of the time I will ask you to open the notes. Alright, so you must download lecture notes, which you can download from AccountancyTube.com in P6 section. Right, now this pro forma, as I said, it is already given to you in the notes, but you must write down on your notebooks, because I will be explaining each and every bit out of it. Then it will be easier for you to it will be easier for you while revising when you are approaching the exam. All right. Also, if you're watching this lecture on a YouTube channel, then please make sure you just subscribe to the YouTube channel, but move to our own website, AccountancyTube.com. The reason you should watch the lectures on our own website is that's where you will find the lectures in right order. Now if you're watching this lecture, say for example on YouTube, now this is the first lecture which you're watching on the new YouTube. Now next lecture might be the lecture number 10 on YouTube, whereas if you want to find the lecture number 2 in right order, that's where you should go, the AccountancyTube.com. Now on AccountancyTube we have divided the different sections for your own ease. So the income tax will be a separate section, then capital gains tax, then in IHT. So it's quite easy if you go to our own website. That's why I would recommend that you should watch the lectures on our own website, because if you're watching on YouTube you might miss any lectures because they are not in the right order. They're first lecture, then it could be fifth lecture, then second lecture, so it's not in the right order. So that's why you should watch the lectures on our own website. Right then, so that is income tax pro forma, as I said. Now before we move to income tax pro forma, let me just give you a little background about the taxation itself. Now taxation, as I think explained in the previous class as well, the taxation is basically government's share in anyone's income, government's share in individual's income. So say for example, if I'm earning something as a salary or trading profit or property income or whatever the source of income is, government has got some share in my income. Now that share is called taxation. So government has got share in everyone's income in the country, be it an individual, partnership, company or whatever. So government has got share in everyone's income, so that share is called taxation. Alright, now if you want to know more in detail about the taxation in the United Kingdom, then please make sure you go to F6 section and watch the first lecture, Taxation in the UK. Taxation in the UK. That is the first lecture in F6 section of AccountancyTube, because I won't tell you in detail how the taxation in the UK works, because I've already recorded one video in the F6 section. So you should go to the F6 section. If you want to know the background, how taxation works in the UK, then you should watch that lecture as well. It's about 20-25 minutes long, but it will give you background how the taxation works in the UK. Alright. Anyway, I will tell you a little bit about taxation in this video as well, but if you want details, you should watch that lecture. Now, as I said, government's share in an individual's income is taxation. Now, in the UK, HM Revenue and Custom, Her Majesty's Revenue and Custom, is an institution which collects the taxation from the people in the UK. Right? So, HM Revenue and Custom. Now, in taxation, if you go back to your accounting knowledge, if you've studied, if you've passed any accounting papers, you know there is an accounting year, right? Accounting year, say for example, from 1st of January to 31st of December, that is accounting year. Now, accounting year is a year by which we are making our accounts in our accounting. If I've started my business now, I want to make my accounts from now to 12 months, ending 12 months, right? So say for example, today is 1st of April. I want to make my accounts in the coming 12 months. So from 1st of April to 31st of March, that will be my accounting year. That's what I'm talking about, accounting. Whereas when we come to taxation, hi guys, sorry for that, there was a technical problem in our recording system, so it was interrupted. I beg your pardon for that. So I was talking about the financial year, the accounting year and the tax year. Accounting year is up to us. Whenever I'm starting my business, I can start my accounting year from that date up till the next 12 months. Whereas the tax year, it is not up to us. HMRC has already defined a period, already defined a date. So tax year start on that date and tax year will end on the date which is provided by HMRC. So both dates are provided by HMRC. Whereas accounting year is up to me. Whenever I start my business, say for example, if I started my business on 1st of July, I can make up my accounts from 1st of July to 30th of June. So it's basically totally up to me. Whereas tax year is not up to me. HMRC says the tax year starts on 6th of April and it ends on 5th of April. So this is the period of tax year. Now it depends on which year we are dealing with. Now for your syllabus, Finance Act 17 is relevant for your syllabus, and that's this lecture and the following lectures are for Finance Act 17 as well. Now our Finance Act 17 starts from 6th of April till 5th of April, but 6th of April 2017 to 5th of April 2018. So our tax year starts from 6th of April 2017 till 5th of April 2018. So that is our tax year. Now I've made up the income tax pro forma on the board, as I said. First of all, we'll have to write down the taxpayer's name on top. So that's what I did. I write down as Alex. I've just made up the name. So Alex is the taxpayer's name in this case. After that, income tax computation. That's what we are doing. And just beneath that, for the tax year for which we are making the income tax pro forma. So in this case, we are making the tax year for the year 17-18, as you can see on the board. So for the tax year 17-18. So that's how we start making the income tax pro forma. After doing that, we'll have to divide the income into 3 sections. That's what HMRC says. Income will be divided into 3 sections: non-savings, savings, and dividends. HMRC says that whatever the sources of income you have got, just make sure you divide into these 3 sections. Now, how can we divide into these 3 sections? Alright, dividend income, I know that if I receive the dividend I can put in here. But what about the other 2? I'll tell you in a minute about other 2 as well. But first of all, say for example, if I hold some shares in a company and that company gives me some dividend, that is source of income. So I will have to list down on this pro forma, and I have listed down already dividend income, as you can see here. So dividend income is already written in these sources of income. These are all sources of income. This is basically description. All these are sources of income, all the expenses, whatever, and then we will have to list down in one of these sections. Now dividend income, as I said, is a source of income, so I've listed down here, and dividend income will go into the dividend column. So shall we put dividend income into the dividends column? So it will go in here. Put it into the dividends. Alright, so dividend income will go into the dividend column. The next column is savings. Now what are the savings? Whenever I am earning something, I want to make savings out of that as well, so that in the future I can use that. Normally what people do is, with that savings amount, they put into the bank account. They put in the bank account so that they can earn interest as well. So after 1 year, if you put £100, after 1 year it will be £105 maybe, so that it will keep increasing. Alright, so with that savings, what you are earning interest. Alright, so interest income is a savings income. Alright, so interest income is here listed in the section interest income. So interest income will go into the savings column. So go ahead and put interest income in the savings column. Right then, so that's what's interest income. So what I do is that whenever I have got the savings, I put that savings into the bank account so that I can earn interest. So interest income, that's why interest income is a savings income. And interest income will go into the savings section. There are 3 sections: non-savings, savings, and dividend. We know that dividends will go into the dividends. Now we know that interest income will go into the savings income. That's it. That was the difficult part. Now the rest of the sources of income, whatever the source of income have we got apart from the savings, apart from the interest income and the dividend income, whatever other source of income have I got, that will go into the non-savings section. Say for example, if I'm working for someone, I've got employment income, that will go into the non-savings. If I've got trading income, that will go into the non-savings. So all other sources of income will go into the non-savings. So go ahead, let's see which of the sources of income have I got here. I got trading income here. So trading income will go into the non-savings. As I said, all other sources of income will go into the non-savings. A pensions income, that will go into the non-savings as well. Now what is pension income? There is a separate chapter on pension. We will look into detail of the pensions, but for now just take it as one of the source of income. Alright, so pension is one of the source of income. So pension income will also go into the non-savings. Next is property income. I might have some property and I would be earning some income out of that as well. So that will go into the non-savings as well. Next is employment income. That would also go into the non-savings. Then we got interest income. We know interest income will go into the savings. Then I got dividends. Dividends we know will go into the dividends. After that I got income from discretionary trust. Now income from, there are two types of trust. One is discretionary trust, another one is interest in possession trust. We will see in detail about the trust when we move to that chapter, but for now just assume it as one of the sources of income. So there are two trusts. One is income from discretionary trust, another one is income from interest in possession trust. So there are two types of trusts. Alright, now income from discretionary trust, whenever I am receiving the income from discretionary trust, tax has already been deducted. Now what I am getting is after tax amount. I am getting the net amount. What I need to put here is a gross amount. Now how much tax has been deducted out of the discretionary trust? 45% tax has already been deducted when I receive the income from discretionary trust. How much I have to put here? I have to put the full amount before taxation. So what I need to do is I will have to take the amount multiplied by 55, 100 over 55. Why I'm doing it? Because whenever I am receiving the income from discretionary trust, 45% of the tax has already been deducted. What I am taking is 55%. Alright? So, however, while listing down in the income tax pro forma, HMRC says you always take the gross amount. All the income whichever you are listing here are the gross amount, not the net amount. So that's why we'll have to gross it up. How can we gross it up? Whatever the net amount is multiplied by 100 over 55, that's how we gross it up, because 45% of the tax has already been deducted. Alright? And income from discretionary trust will always go into the non-savings income. As I said, all the income will go into the non-savings apart from the interest income and dividend income. Right, then the next is income from interest in possession trust. Now this is also a trust. Other one was discretionary trust, whereas this one is interest in possession trust. Only difference between these two is that was paid after collection of 45% tax, whereas interest in possession trust has been paid after collection of 20% tax. So if it is paid after 20% tax, we'll have to gross it up. How can we gross it up? I will have to multiply it by 100 over 80. That's how I gross it up, because 20% tax has been paid. Right. So whichever it is paid out of, if it is paid out of non-savings income, it will go into the non-savings. If it is paid out of savings income, it will go into the savings. If it is paid out of the dividend income, it will go into the dividends. Next one is a deductible interest. So next thing to do is to deduct the deductible interest. Our preference would be said that we should first deduct it out of the savings income. Next preference is to deduct out of the first preference is to deduct out of the non-savings income, then from savings, and finally if there is any left from dividend income. Alright, so deductible interest will be deducted first from non-savings income, then from savings income, and finally from the dividend income if there is any left. Alright, now non-savings income might not be sufficient enough, and we might have to, and the deductible interest might be more. So that's why we should first deduct from the non-savings income, and if there is anything left out of the deductible interest, then the remaining part would be deducted out of the savings income, and still if there is something left, then we will deduct it out of the dividend income. All right, so our first preference is to deduct from the savings, is from the non-savings, then from savings, and finally from dividend. I will write it down here as well. So first preference is non-savings, my second preference is savings, and my third preference is out of the dividend income. All right, and after that it will give me the net income before personal allowance. All right, so that will be net income before personal allowance. Next thing to do is to deduct the personal allowance. So personal allowance will be deducted, and again there is preference. Personal allowance will first be deducted from the non-savings income, then from savings, and finally from dividends. So first preference would be non-savings, then savings, and finally from dividend. If you want to write down the preference here as well, you can write it down. And after that, after deducting the personal allowance, the remaining amount is going to be taxable income, as you can see here beneath that. All right, so if you want to write down the preferences, you can write down here as well. So it would be first preference, and the second preference would be from the the savings income, and the third preference would be from the dividend income, and after that, that would be my taxable income. All right, so taxable income would be the last one. Now after taking the taxable income, now this is the amount on which we will have to pay tax. Now how to calculate tax? There are different rules. Up to that amount, that is that percentage, and from this amount up until that amount, there is a separate percentage. Now this percentage is given to you in the lecture notes anyway, but we will move to the lecture notes later on. But assuming that we have calculated the tax liability, come here. So whatever the tax amount is, it will reduce the tax amount. All right, so that's why VCT is good. So if you invest in venture capital trust, whatever you have invested, 30% of that will go here. It will reduce the liability, it will reduce the tax which you have to pay to HMRC. Likewise, EIS, enterprise investment scheme. Now if you invest in EIS, 30% of that as well will be given as tax reducer. So if I invest in VCT, 30% relief. If I invest in EIS, 30% relief. If I invest in SEIS, Seed Enterprise Investment Scheme, 50% relief. It's enormous amount. So if you invest in SEIS, Seed Enterprise Investment Scheme, 50% of that is a tax reducer. So whatever the tax liability is, it will reduce the tax liability. 50% of what? 50% of the amount you have invested in Seed Enterprise Investment Scheme. All right? But there are certain conditions. We will look at these schemes in the next couple of lectures. There is a separate topic. There are certain conditions to meet before you can get this relief. All right? So anyway, these are the tax reducers. So we have calculated the tax amount. Then we will reduce the tax amount, assuming we have invested in these schemes. So the tax amount will be reduced. That's why these are called tax reducers. Right? It will give us the tax liability here. So that is the tax liability. And after that, we'll have to deduct the tax deducted at source. Now, what is the tax deducted at source? Remember that I told you that while making up this pro forma, we will always list down all the sources of income, but we will list it down as gross, regardless of the tax deducted. Even if the tax is deducted, we will gross it up and write it down here. The example is income from discretionary trust. The example is income from interest in possession trust. 45% of the tax was deducted from income from discretionary trust, but we have grossed it up. Likewise, from interest in possession trust, we've also grossed it up as well. So we will always gross it up. Now the tax deducted at source is that HMRC says whatever the tax was deducted while giving to you that money, deduct it out of here. All right. So tax was deducted from income from discretionary trust. How much? 45% of that. So 45% of discretionary trust, we will deduct it here. So we'll take the gross amount, that gross amount, take the 45% of that. It is just 45% of that. So 45% of discretionary trust, we will deduct it. Likewise, 20% of interest in possession trust. because 20% tax was deducted, wasn't it? But we have listed down as gross. So we'll take the gross amount, take 20% of that, we will deduct it here. Likewise, pay as well, pay as you earn. Now, what happens is that in the UK, while you're working for someone, when they pay you the salary, they already deduct some tax. Now, that salary, the tax which they have deducted out of the salary, that is called PAYE, pay as you earn. All right. So while listing down the employment income here, we will list down the full amount. However, we will deduct the pay from here. All right. So pay, income from discretionary trust, income from interest in possession trust. All this amount will go here and it will be deducted out of the tax liability. So it will reduce the tax liability. And the final amount, if it is a positive amount, it will be income tax payable. If it is a negative amount, then it will be income tax receivable. All right. So if it is a positive amount, it is payable. However, if it is a negative amount, if it is in the brackets, then this is income tax receivable from HM Revenue and Customs. So that was our income tax pro forma. That's how we make the income tax pro forma. The quick revision. First of all, taxpayer's name, income tax computation for the tax year, whichever tax year is. Income is divided into three sections: non-savings, savings, and dividends. Dividend will go into the dividends. Interest income will go to the savings. Rest of the stuff will go to the non-savings. Income from discretionary trust is grossed up because 45% the tax was paid. It will go into the non-savings. Income from interest in possession trust is also grossed up because 20% tax was deducted. It will go into the non-savings, savings, or dividend depending on what the question tells you. If the question says paid out of dividend income, it will go to the dividend income, but always gross it up, multiply by 100 over 80. All right, so that was interest in possession trust. After that, what we do is we deduct the deductible interest. Now, what the deductible interest is, we will see in the next video, but just assume that it is a deduction. So we'll deduct the deductible interest. After that, it will be our net income before personal allowance. Now, after that, we will deduct the personal allowance. What the personal allowance is, I will tell you in a minute. We will deduct the personal allowance and deductible interest. There is a preference. First preference is to deduct from non-savings income, then from savings, and finally from dividend. All right. After deducting the personal allowance, that is our taxable income. Now, taxable income, we will have to calculate tax on that. Tax rates are given to us in the question paper, in the exam. These are also given to us in the notes we will see in the next video. So whatever the tax rate is, take the amount, multiply the tax rate. So that is our taxable, that is our tax which we have to pay. Now it will be reduced by the tax reducers. There are three schemes. Which schemes? Venture capital trust, enterprise investment scheme, and seed enterprise investment scheme. So 30% in VCT, 30% in EIS, and 50% in SEIS. So that will reduce our tax liability. All right, so that will be our tax liability. Out of that tax liability, we will deduct the tax deducted at source. All right, so tax deducted at source is pay as you earn, then 45% of the discretionary trust, and 20% of the interest in possession trust. After deducting that, if it is a positive figure, it will be tax payable. If it is a negative figure, it will be income tax receivable. Now, a couple of more things before I wind up this lecture. Deductible interest. Now, deductible interest is an interest, as I said to you earlier as well, that whenever I take a loan and I invest that loan in one of the reasons, in one of the projects, then HMRC says then interest which you pay on that loan is deductible from this computation. So I go to bank and I ask them that I want to take the loan. The bank says, why you want the loan? I said I want to invest in my business. Then they give me the loan, I invest in that business. Now the bank won't give me the loan for no interest. Obviously bank will say you will have to pay me some interest. Now interest which I am paying on that loan I have used in my business. Whichever the interest I am paying, that interest will be deductible. So that is deductible interest. That was one of the reasons. So what was the reason of my loan? To invest in my business. The reason could be that I want to buy a plant and machinery in my business. So there could be many reasons. We will see them reasons in our next video when we talk about the deductible interest. But deductible interest simply means I go to my bank, I ask them that I want some loan, I want to invest in the business. They give me the loan, I pay interest. That interest is deductible out of here because it will reduce our income tax liability. It is a benefit. Next thing is personal allowance. What is personal allowance? In the UK, HMRC says that if you are earning up to £11,000, £11,500 a year, then you don't have to pay any tax at all. Alright, so that is personal allowance. That is basically exemption, which everybody in the UK is eligible. So everybody in the UK who is earning 11,500, they don't have to pay any tax. Even if you are earning more than £11,000, £11,500, so whatever your total amount is, we will have to deduct the 11,500 out of it. Say for example, if you are earning £50,000, 11,500 we will have to deduct out of that. Whatever the remaining amount is, we'll have to pay tax on that. So that is our personal allowance. Now personal allowance is 11,500 in most cases, but it can be reduced. We will see in one of the next videos how it will be reduced and why it will be reduced. Alright, but for now, just take it as personal allowance 11,500. Write it down on your piece of paper. Excuse me, personal allowance is 11,500. And it changes year by year. For our current tax year, it is 11,500. Years ago, it was 6,000 as well. Excuse me, so it could be 15,000 in the next couple of years, you never know. Alright, so that was personal allowance. Apart from that, I think I have covered everything. Now these heads which I've listed down here, trading income, pension income, property income, most of this stuff has got a separate chapter on it. Trading income, for example, has got separate chapter on it. Pensions has got separate chapter. Likewise, property income, employment income, they all got separate chapters. So don't worry, we will see how to calculate trading income, how to calculate pension income. So there is a separate chapter on each and every bit. So that was our income tax pro forma. I hope you understood it, and if you have any questions, drop me an email. I will try to respond ASAP, but please make sure you note down this thing. Just write it down like this and that bit, because there wasn't enough space beneath that. That's why I've transferred on that side. Otherwise, I would have written just beneath that. All right. So that's it for now, and I will see you in the next video, and we will continue with income tax pro forma. We will see some of the stuff like deductible interest, personal allowance, and some other stuff as well in the next video. Till then, goodbye.